Welcome to Orrick. My name is David Concannon. I'm a partner here at Orrick. I represent technology companies, investors in technology companies through our emerging companies group. This is part of our Total Access program, where we put together panels, teaching sessions, pitching events that are intended to sort of connect and inform people in the entrepreneurial community, including entrepreneurs, founders, investors, and others who work with them. We've got a very interesting panel today, I think, and timely. It's going to be a liquidity panel about current trends in M&A and IPOs. But it's also going to talk generally about things that are, less sort of less related to the current cycle and more to those processes generally. We've got a great panel of experts on this, including investors, management, and bankers who can, I think, give some thoughts from around the table on each of those types of transactions. So before we get started, would like to ask the panelists to each introduce themselves, starting with Will Porteous tomorrow.
Hi, I'm Will Porteous. I'm too close to the mic. I'm a general partner and the chief operating officer of RRE Ventures. We're one of the most active early stage investors here in the New York market and nationwide.
I'm Brian Griffiths. I'm the managing director at Credit Suisse in our technology group. I run a business called Enterprise and Communication Systems, which encompasses all of the enterprise networking, compute and store, security, all the telecom infrastructure, all things mobility related, all the cloud infrastructure. So it's a rather broad and extremely diverse universe of companies that we put that business together a couple of years ago. Before that, I spent 12 years in London running our TMT business over there, which was also covering a very broad and diverse group of companies.
Nikita Kouloupe, I'm a partner with Inside Venture Partners, a block and a half away. We have about $7.5 billion under management. Our check size is a little bit larger. All that means is we overpay for companies after RRE as well. And I split my time between working with all of our recurring revenue businesses. My particular interest is education, but I also run the group at Insight that assists our investments post-deal, which is about a third of the professional staff of the firm.
Hi, I'm David Ethridge. I'm neither management nor a banker nor investor, but I'm a reform banker, and I spent 20 years on Wall Street in the banking world, most of my career around the IPO business, and 3 years ago I joined the New York Stock Exchange, where I'm responsible for the IPO business there. So most of my interactions with people like yourselves who are thinking about, do we sell, do we go public? If we go public, where should we list? So looking forward to participating in today's panel, so appreciate you having me.
Hello, I'm Tim Bixby. I'm the Chief Financial Officer at Shutterstock here in New York. We are a public company, traded on the New York Stock Exchange. We license images to businesses worldwide, along with video footage. And we have been public for just about a year. We took the company public in October 2012. We listed, or priced rather, at $17 a share. We did a secondary about a month ago at $60 a share. We're currently trading at $73, $74 a share. The company has a market cap of about $2.5 billion. I also was part of a team that took a prior tech company public in the year 2000, when many of you and I were much younger, on the NASDAQ. And happy to be here. Thanks.
Okay, that's great. Thanks all. So to sort of get ourselves started, we thought we'd have a quick sort of overview summary on each of the IPO and M&A market from David and from Brian. So Brian, maybe if you want to give us a few remarks about some overviews for
I guess just very quickly. I think I describe my business, and you see it's a very diverse business, and I think it's the diversity of my business is indicative of how much more complex the landscape has become within technology M&A. In the old days, it used we were very siloed, and within each silo, the software silo as an example, you talk to the big companies who are the buyers, the little companies backed by the VCs who are the sellers, and it's very happy little ecosystem. These days, those silos are really broken down, and there's sort of a scarcity of quality smaller companies these days. So it has become much more, I guess it's a complex landscape with lots of opportunities, but also many challenges. If I sort of distill down, what's going on to the, I guess sort of the 5 trends that we think are shaping technology M&A, would be first, from a technology perspective, there's really 4 meta trends: mobility, cloud, social, and big data, that are driving tremendous growth and really redefining sort of the winners and the losers. And also those trends, again, are very much blurring the lines between the traditional silos. You think about companies like a Google and Oracle, I mean, they span almost, the entire technology spectrum. The second thing is consolidation in technology has resulted in far fewer, but much more diverse large cap technology companies. And the other side of that is, we're finding the small mid-cap companies are really getting marginalized as they lose customer mindshare. And third being, those leading large cap tech companies have virtually unlimited cash these days. If you look at the top 10 tech bellwethers as of Q2, they had $500 billion of cash available. That's great. That's also increasing the pressure on them to return that capital to shareholders. So you've got a real competitive force asking for those dollars as well, and returning them in terms of dividends and buybacks. And related to that is force number 4 with the advent of some new players in the tech M&A market, namely the return of the private equity guys, and more importantly, the activists. After a couple-year hiatus, private equity guys are back, really driving being agents of change, deals like the Dell deal. And then we've seen the activists getting increasingly vocal in their roles, particularly with companies that have a lot of cash that aren't growing, and demanding that cash get returned. I mean, even Apple is not beyond the reach of the activists. And just yesterday, you saw Third Point come out talking about their ownership in Nokia, which doesn't even have the cash yet. The deal that they're referring to is going to close sometime next year, where they're going to have a lot of cash after they sell their device business to Microsoft. But Third Point's already on the prowl, indicating that they want Nokia to do something with that cash. So it's a really new phenomenon. And then lastly, it's interesting the confluence of all these circumstances where you've got all these winds of change, really changing the competitive landscape, an improving economy, lots of cash, great stock market, essentially free money in the debt markets. That should drive lots and lots of M&A, you would think. The reality is volumes remain quite low in our business, and I think a big part of it is actually there's almost too much complexity, both in terms of the technology trends and figuring out where you're going to make your bets, who's going to be the winner. It's much harder to pick the winners these days. And also complexity in terms of the macro environment that we have that I think is undermining CEO and board confidence. So, it's interesting times where you've got a lot of change and, I think a great potential for M&A, but so far it's been very frustrating for us the last really year and a half in terms of the actual volumes. Sorry, went over 5 minutes.
No, Brian, I don't think you did. That was great stuff, and I'm sure that's going to inform a lot of the discussion going forward. The other thing, too, I should note, towards the end of this, we'll definitely make time to take some questions from the audience. So, Bryce, any thoughts?
So, keying off some of Brian's comments, I'd say the IPO market right now is something that we haven't seen since 2007. And when I say that, what I mean by that is when you look historically at the IPO market, you generally have a really bad quarter, a really good quarter, and 2 sort of Goldilocks just right kind of quarters, not too hot, not too cold. But this year we've had 3 really good quarters back to back to back. So the macro environment for us has been absent Greece, absent EU concerns, and until just recently absent any sort of self-inflicted pain in the US. And then of course we had the government shutdown, and you can already see the effect on the IPO market just from that. I'll give you a stat. So this week on the New York Stock Exchange, we'll have 1 IPO. Next week, we'll have 10. So you can see people kind of gapped it out and said, do we want to straddle this problem we have, or do we want a little wait for clarity and then launch? And that was more the strategy most people took. A couple exceptions like Viva, CommScope, others straddled it. And I think they're going to do well by that. So in any case, it's been a really good IPO market. To give you some other data points, as of August 31st, we've done north of 70 IPOs on the New York Stock Exchange, and raised over $23 billion in capital this year. That was the same number we had done in all of 2012. So this year, I think the market has a chance to get north of 200 IPOs, but the fourth quarter is always kind of dodgy. We always seem to find a way to screw it up from some sort of macro issue in October. So far, so good. We got through the one that we created. But then you have to deal with Thanksgiving, you have to deal with the year-end holidays, and that sort of chops up your market. So you have to crank a lot of volume through in a short amount of time to really make the fourth quarter terrific. And sometimes we get that done. I think we have a shot at it this year. In terms of my worries, it's around what's the next sort of big issue. Maybe it's the taper or something like that. But what I like about this market right now is nobody's talking about a bubble. This is just steady state, good volume, cranking through all sectors. Pricing dynamics are really healthy. So what we're seeing is, roughly 75–80% of the deals getting done inside the range. So that means the bankers are getting it right, investors buying it, and then they're trading well. Not as well as Tim's company, but they're trading extremely well, and this obviously is based on a lot of results. Those guys did it right and hit their numbers when they came out of the box and kept going. So that's a terrific market we're in right now. And the only place I can say that's unusual and in a positive way is the biotech market. This market is one that one of the investors said is sort of like a cicada rhythm, comes around once every 17 years, and we got to hit it as hard as we can. And you've seen like 35 biotech IPOs this year. I think there's a direct point that you can tie back to the Jobs Act for that sector, because of the work they can do on a confidential basis, testing the market, talking to the PhD on the other side of the table at a buy-side account to say, here's what we do you like this? And so it's interesting for me to watch that sector blow out post-Jobs Act, and it may just be a total coincidence, but I think there's a linkage there.
That's great insight. And we'll, I'm sure, come back to many of those points, including that one in particular. So we talked among the panelists, and one of the things we thought would be useful to inform the discussion was to talk about the point in the road when companies and management and investors will be considering an M&A transaction on one hand or an IPO on the other. So it necessarily presupposes that you can do an IPO, and so what does that mean? It means you probably raise some financing, you've been around for a while, you have a fairly mature, although certainly still growing business. Probably means you have 100 million or so or more in profitable revenue. Probably means you've shown, as we said, year-over-year growth, including some EBITDA growth. And you've got a management team that is, more or less executing. So, given those preconditions, in the decision tree between going public or having an M&A event, we wanted to start the panelists off with some consideration of, we'll start with you, Will. As an investor, what are some of the reasons? Obviously, these provide liquidity for people, so that's one strong reason that favors each of those things. But what are some of the other considerations that you talk about
Sure.
among yourselves and also to management?
Well, so let's put ourselves for a second in the CEO founder's chair. The company that David's just described is doing really well. It's grown to substantial scale. It's got a product that's getting meaningful traction out there in the market. The business is working, and the company is confronted with perhaps a great set of options. Potentially to go public, potentially there are strategic acquirers who have an interest. And there are all sorts of other pressure points on that founder and CEO. That business may need money to grow. We just saw this morning that Outbrain opted to take $35 million in new funding. It's been presented in the news and as an alternative to their going public. We're not investors in Outbrain, I don't know anything special. But it brought to mind to me the fact that at the end of the day, these are financing events. An IPO is a financing event for a growing company. It may carry with it some liquidity for early investors eventually. It changes the dynamic incredibly. But at its core, that CEO and board has made a decision to go to the public markets to get the capital they need to keep growing and keep the story going. That CEO has pressure coming at them from early employees who who are big stockholders who probably have been working at below market salaries for a long time and they want to get liquidity. They have early investors. Among those early investors are probably a number of very influential mentors who are sitting there saying to the CEO, you've done a great job. Now I'd really like to take my chips off the table. So it creates, I think, a ton of conversations for that leadership team that can be really disorienting. And we've watched a lot of our portfolio CEOs go through this. And those that haven't been through multiple transactions, or like Tim, and Tim should comment on this because he's lived this many times, those who haven't been through multiple public offerings, it's still, for some very capable people, a new experience. So I think it continues to be a topic with a lot of real fundamental questions, like the ones I've enumerated, that often get overlooked.
In the case, we'd love to hear you.
Just to tie something that between David and Will, comparing today to a year ago, the decision tree for an entrepreneur has more branches, period. There's other forms of liquidity available today that were not available a year ago. Some of that has to do with debt, although being the only Greek partner inside, I'm not allowed to talk about debt too much. But we are in the business, so if you look at what my firm has done this year, we have put $1 billion to work year to date. A lot of that was liquidity. It did not include outright M&A. A lot of that liquidity was in minority positions, but it provided a platform for the CEO, founder, to answer the questions from early investors, to answer the questions from mentors, angels, early employees, folks who are no longer with the business perhaps. And we are, as long as incentives are aligned post-deal, as long as everyone is happy at the same time post-deal, we're very happy to provide that liquidity. Debt players, debt is very cheap. That's a way for us to get liquidity. Leverage recapitalizations, dividend recaps. We just closed a deal a week ago with a very good recurring revenue business, 0 covenants, all the money coming out of the business, which is very profitable to begin with, a little over 3 points. Which is free money, essentially. So those options may have been available standalone for the best of companies last year. Now they're very available for a wider band of companies today. Even a company that is not in the profile of kind of EBITDA positive, good recurring revenue with good customer economics, where you can basically show a path to profitability that's quite demonstrable, will very much consider liquidity, even for folks who are instrumental in running the business. Partial liquidity, we think of it as, if the CEO gets their mortgage paid off, their risk profile changes, but they still show up for work because most of their equity is very much tied up in the business, so our incentives are aligned. So that's how we see it.
So Tim, as someone who has been through this a couple times, just maybe taking the other fork in the road and being involved, how did you, and you've already been out the other end, but how did you perceive it on the front end in terms of what it was going to mean, for in the life of the company, and also just in your association with the company and being CFO of a private company, going public there and then being public afterwards?
I think maybe comment from a couple perspectives, so sort of the CEO founder perspective, which I'm not, and then from the CFO kind of managing perspective. From the first perspective, I think the questions sort of follow these comments. The question that you, whether you're the CEO or the founder or both, and your team probably need to ask are like, why do you want to do this? Whether it's an M&A transaction or an IPO or something else, but focusing on those two. What do you want to do? So do you want to run a company longer term? Yes or no? Because I think an IPO is a route that enables you to do that for probably a longer period of time in most cases. Do you want or need money now, either personally or to have investors take some money off the table? That, as often as not, may push you the M&A route, or the refinancing route, or the deal route. Do you want to create substantial wealth long-term versus short-term? That I would suggest may push you more towards an IPO. The thing about going public that I've learned after having been through it a couple times is that while there's nothing about it that's super easy or super predictable, it's a known path. Many, many companies have done it. The exchange has done it many times, the accountants have done it 1,000 times, the lawyers have done it. So the path is very well defined. The deal route, the M&A route, is by definition uncharted. No one knows how it's going to end up because every single one ends up differently. The deal can happen and get done and signed, but the actual end result, a year, 2, 3 years later, it is always by definition very different. So our founder, and we kind of were I was part of some of this discussion, but not all, because our founder had been running a company, has been running a company for 10 years, decided the latter. He wanted to create long-term wealth. He had no immediate urgency for cash. His primary investor, Insight, was a patient investor. And all of those things coming together enabled John, the founder, to put together a team of folks who had kind of been down this road before and give him a lot of comfort. And that's kind of where we came out of.
So among the things that one looks at when you're thinking about the benefits of long-term being public, and there are some burdens, obviously, the reporting and just some other specific limitations, on corporate behavior, is the prestige of being associated, with being a public company, also having public stock as acquisition currency. So that maybe brings us back, Brian, to maybe some of the trends you're seeing. You're talking about these huge cash hoards that people are sitting on. There are a couple things that we see going on, on a macro basis, including sort of foreign acquisitions, so that U.S. corporates can avoid repatriating cash, and also sort of slowing down the velocity maybe of M&A to the extent that it's not that it's going to be U.S. based. But you see, in terms of the cycle of M&A activity, are we at high watermark, low watermark, somewhere in between? In terms of the use of stock as currency for these acquisitions, because as you talk about, you've got big corporates, they've got so much cash, they'll do everything cash if they want.
Yeah, I mean, I feel like we're at a historical, I actually don't know the statistics, but it feels like we're at very much a low watermark in terms of use of stock as consideration. And we really saw coming out of the global financial crisis when, when stocks started to trend back upwards, that big cap companies who were putting cash to work were getting rewarded on announcement. I mean, so obviously you'd see if a target was public, you'd see their stock pop. But we're also seeing quite a remarkable stock pop on the part of buyers using cash to put to work in acquisitions, and basically investors rewarding companies for basically acquiring more growth. And so it's really I think dominated our thinking, and I guess combined with the fact that even if you didn't have tremendous amounts of liquidity, there has been so much debt available, at incredibly attractive rates. That's really dominated our math over the last 2 years. Is the cash and potentially using debt financing, and so I think our very much push the all stock deal in particular sort of to the back burner. I feel like we're going to start thinking about that more again. Particularly, you start thinking about you've got the big the Big Ten up here with their 500 billion, but then you've got a really big population down here who maybe don't have $50 billion of cash lying around. I think we're going to start seeing some more stock deals coming, particularly as you think about where we are in overall stock market perspective. I mean, we're kind of back to all-time highs from a stock market perspective. So, people start thinking, well, it's sort of a relative value discussion at this point in terms of cash sort of crystallizes absolute value. I think where we are now, when the stock prices were depressed, that would maybe you could think more about absolute value. And where we are today, and more fully valued stock prices, I think it's a relative value discussion where I think you're going to see more stock deals.
Will, you had talked about Ethridge as being one, and I can't recall if the reporting on that was that they had filed or that they had maybe confidentially filed, or people expected them.
The reporting has been they don't know if they filed or not, and they're not required to have tell the world if they have, in fact, unless they have more than $1 billion in revenue. I think we have seen a wonderful wave of private deals, and the Insight guys have been real leaders in this area of helping companies sort of create alternative financing solutions, whether through debt or other things like this Outbrain deal. I think it's had a really interesting sort of effect because it's changed the tempo and changed some of the pressure points on that management team that I was alluding to earlier. And perhaps it's postponed some companies going public, or perhaps it's allowed them to consider sort of some new directions. That to me has been one of the real seminal events of the last 18 to 24 months.
So when you look at your portfolio these days, and there's a decent amount of inbound, at least at the top of the, at the top of the pipeline, among those that you know which ones are winning, and it's not uncommon to hear. Does that tend to be the big corporates? Because so people think of M&A in particular, tech M&A here in New York being dominated, and I think there's a pretty recent report by CD Insights out about this being dominated by Yahoo, Google, some others. Do you see, are those the main acquirers that you're seeing? Are you seeing others?
We're seeing, so as an investor, we participate across a wide range of sectors, from component and systems businesses to a variety of infrastructure, both hardware and software, to a lot of application layer things, including some e-commerce businesses and mobile. So we touch a lot of sectors in IT, and that leads to a lot of sectors of potential acquirers. And for our media properties, I'm happy to say that some of their M&A interest seems to be local. For our more fundamental systems businesses, we seem to be exporting. We announced earlier this year the sale of Whiptail to Cisco Systems. Whiptail's a solid-state storage systems company based in New Jersey. Our portfolio company MakerBot, also here in the New York area, was acquired by Stratasys. And this is, these are big companies with the profiles. At least certainly in Cisco's case, like Brian described. Sort of stepping in, and management team saying, yeah, our best path forward to continue to grow this business is as part of a larger entity. And I can't tell you how much that thinking dominates, particularly in a lot of the enterprise and systems spaces. One of the consequences of the consolidation that Brian was alluding to earlier is that it's just much harder than it ever was before for the venture-backed company to build the distribution and field support and account management infrastructure that it needs to support the big enterprise customer. It's harder than ever. And so the decision point of, okay, we've got a product that these customers love, and we've gotten to some number between, call it 20 and 50 million in sales. The decision point of whether to sell or to try and raise a huge amount of money to grow that infrastructure, it becomes sort of obvious what to do, particularly if you can get paid the multiple you think you deserve.
And just to build up on that, that's certainly true on the enterprise. If you look at what's happening with businesses selling to consumers, cost per lead is being dominated by not so smart dollars coming from large enterprises that will spend for a brand without counting the beans on the other end. Anything selling into small businesses, or most companies selling into small businesses, are suffering from churn that necessitates more than one sale over the lifetime of the customer. They don't quite know what they will sell that second or third time around. And anything having to do with apps, getting on the top 20, 30 of any kind of, forget iOS, that's even worse, but even on Google's top list, it's become akin to marketing for a movie these days. So you do need more money. You do need money on the balance sheet, and sometimes you need conversations around distribution, folks who are spending that money already to promote your thing alongside others. That could also lead to a wonderful M&A discussion. The one thing about M&A versus IPO, at the risk of stating the obvious, good advisors, and I'm working with Brian's firm on something right now, they will ask two questions and will say, is there a clear public to private premium in your space? Certainly that was the case in Shutterstock's map. There was such a command of such a premium on the public markets that it made a very big difference in which way the deal went. But they will also tell you, leveraging the Jobs Act or choosing not to use the confidential filing, it's a wonderful way to show the world that something's happening. There is a deadline. So strategics, one and all, come and knocking, because this is the time. You may miss the opportunity. Some may choose to wait. One of my portfolio companies, Exact Target, we went through this math, went public, and then Salesforce bought them a year and a half later for twice the price at which we went public. So they may choose to wait, but it's a wonderful way to showcase that, here's how well I'm doing, here's a deadline, this is the time.
So this is, people often refer to this as a dual track process, and people often think of it as, you're on the precipice, you'll either go one way or the other. And I had assumed that it was probably more beneficial to be able to do that confidentially, because you get more bidders more comfortable with being involved in the process and not perceive it to be as frothy as it would be if you were otherwise a public filer. So that you could actually say, no, we're not kidding around, we really filed. We haven't been able to keep it confidential, but we're good to go. That creates real bidding incentives, I would think. And Brian, you're nodding. Is this something that you think we are seeing more or will be seeing more?
Well, I think, I think on balance, I think the Jobs Act is good to have a dual track process where you do have something real and tangible. You can say we filed, but it's not as big a hammer as a public filing. Where you're really sort of putting buyers under pressure. You tell potential buyers, look, we are on file, we are going forward. Come give us your best shot now. But it also, but it's I think less pressure than a public filing, which I think buyers appreciate. Feels like they feel like they can do their work, and they maybe have a little bit more flexibility around the process. It also does give sellers an out if they want to extend that process, take more time. It's they're not the glare of the public filing where they feel like they've got to stick to a timetable. So I think on balance it is quite beneficial for the dual track.
Yeah, and I'd say another nuance to that is some people are just doing a press release, or in the case of Twitter, a tweet to say we filed, and I think that unlocks a lot of employees who have heard the whispers in the hallway of the water cooler that we're going public, and then they're not sort of in jeopardy to talk about it. But you're still free to do everything with Brian's team that you otherwise do, and you put everyone on notice.
Well, David, and as you were saying before, speaking of Jobs Act, testing the waters is something that you think, in particular in the biotech sector, is something that you've seen?
Yeah, so I mean, look, the Jobs Act was a very layered piece of legislation. From the stock exchange perspective, I worked on it for a little over a year, looking at the on-ramp portion. Which is, I think, the most relevant piece to this room. There were other parts to it, but like crowdfunding and the like. But with respect to the IPO, we saw different pieces of it that had been picked up at different rates. So the confidential piece, we had somebody file day one, a couple of them with that, ability. So, but then for the year, you saw 65% uptake, and that was a study by Latham. It's a really nice piece, But what's really true is when we exited the year, we were at kind of 99%. I mean, everybody that can do it and said, what's the downside of this?
Yeah, why wouldn't you include 2 years of financials instead of 3?
Well, and then you've seen other pieces like that. That's right, David. So why not do 2 rather than 3? Particularly if I'm a carve-out from a large corporate. Why do I want to go recreate a financial that's hard to create in the first place from 3 years ago that won't be relevant? Or the test the waters piece. I think this was one of the slower adoption pieces, because the banks and the SEC and the investors had to figure out a methodology around doing it. How do we execute on this in a way that doesn't jeopardize anything that we want to do later? They've kind of figured that out. And so you've seen some pockets, like in China, all those companies do that. They fly over here, and then they say, will we be successful? And then they fly back. And then they come back and actually do the IPO. If you presented that idea to the Chinese, in 2010, they'd say, forget about it, I'm never going to do that. I'll just fly over one time, get this done, and go home. Biotech makes a ton of sense. Very hard to necessarily just trust a banking team that you can get it done when you're preclinical. Like, what are you really going to talk about? And so it gives you a chance to have a real dialogue with people that are going to buy your transaction. So I think you've seen that adoption rate go up. it's layered and it's accelerating in terms of helping people.
So yeah, and just to be clear for people that, on testing the waters, it basically was a relaxation under the Jobs Act of things that might be considered gun jumping in order to determine whether there's going to be a market for your offering. It enables companies and their bankers to actually speak with buy-side accounts, figure out if there's an interest in the deal before they actually pursue it, without having violated Section 5 or making a legal offer. So that's useful. David, one of the things that I think your position at NYSE gives you a lot of insight into is you see not just the NYSE funds, but all of them, obviously, but in particular firsthand at NYSE. So, many years ago, I remember people saying, "Oh yeah, you need to have $100 million worth of revenue, or you can't really go public." And really, I think, in the last couple of years, it seemed like the chatter I heard about there was more like, no, it has to be 150 million. And I know you and I were talking aside earlier today. People seem to be ignoring some offerings out there that are flouting these universal rules, I guess.
Yeah, those myths persist, and we can talk about why that might be the case. But I think if you actually look at the data, you'll see a healthy number of companies that are sub 500 million going public in terms of market cap, and sub 100 million in terms of revenue, even forecasted going public. And I think that's a healthy dynamic. We're effectively saying, hopefully, I think, that people are saying, well, if I want to dream like these guys did, dream big about running a company, I could potentially take it earlier, so a high-quality company just happens to be going earlier than what I was able to do, say, 5 years ago. You're seeing that in the market. 95% of the deals are going to be sub 1 billion. That is the IPO market. Then the question is gradation down from there. The one thing that might sort of flip that around right now is the markets overall are up north of 20%, so everything has been floated up. But if you look back to the beginning of this year, when we had a really healthy IPO market, but the overall base market hadn't gone up as much and rising all the boats, you saw somebody like Rally go public. I think when they went public, it was around 300 million market cap. It may have even been sub 300 where they filed, but it got some momentum behind it and then priced north of there. You'll see a lot of that, and I think that's quite good for the market, as long as they don't then get orphaned, right? And that's obviously the risk, and that becomes a real problem. And that's where Brian says, "I told you so." You should have taken all the money off the table right out of the gate, because now you're, as a VC, you're locked up for 180 days. They've missed the quarter, and you're sitting there and you're going, "What are we doing now?" So I totally recognize that risk profile, but there are a lot of companies that go public that are south of the numbers that people.
Well, then what do we think? And I invite anybody to comment on what. I mean, you'd have to be somebody who's got a real demonstrable velocity growth, who's going to get interest in people if you're going to do it at that point, right? Because you don't want to get stuck in there where you're neither fish nor fowl. You're not big enough for the banks to cover. You're not big enough for the mutual funds to want to invest in.
Probably better for Will or you to answer that than me.
Well, you have quality of revenue is $100 million e-commerce revenue business with 10% gross margins is very different from a $10 million recurring revenue business that has demonstrable, very low churn, dollar churn over 100%. I mean, that's, so quality of revenue is one big thing. The other is, we've discussed that the IPO is a financing event. Showing on the bottom line, you certainly don't need to be profitable, but showing how the money that you are raising will be put to good use to eventually get to good profit margins. I mean, that's really the story that needs to be well articulated by the time you go public, which means there's a difference between expenses that are around infrastructure building. I need to make sure that all the building blocks are there upon which I can start pumping variable cost. That's usually something that you think about before going public. But once that's done, you raise money to hit variable costs, showing good customer economics, so that ultimately you can show, if you show positive customer lifetime value when you go public, that's a wonderful thing. And the market is seeing through good revenue and bad revenue, increasingly seeing through how you get to profitability. Our issue is that some companies are taking it a little too far, where even for the initiated, it's just very hard to see how the story ends. So in terms of, there's a lot of folks who are filed confidentially, and maybe they are testing the waters on how far can I push to tell my future story. And time will tell how successful these offerings will be.
Or whether they were really a dual track.
Or whether or not they will become offerings overall, I mean, we may never know, what happened. We may hear financings that happen.
Right.
Because the dual track can now be a track to not just an M&A deal, but to a later stage venture round.
So Brian, to you, Nikita had mentioned earlier, the idea of doing, leverage recaps or just doing, direct secondaries for liquidity. Is that something that you're seeing just a lot of across the sphere of clients that you work with?
Yeah, I mean, that's, it's been, essentially, in our business, if there are 8 cylinders, sort of, the leverage finance business, it's kind of 3 or 4 of those, and that's really powering the whole engine. The IPO market, the ECM business for us has been good. The IPO business has been good, but not great. M&A has been fine, but not great. Leverage finance business, is absolutely on fire. We're all worried about next year because this can't go on forever. We thought, earlier in the summer when there was, the specter that tapering was actually going to begin, and you saw the market really back up on the leverage finance side. But we're right now, 10-year is yields are going down again. Monies are pouring into the loan funds, CLOs. It's kind of it continues to be as good as it gets. But we all know someday it's going to have to turn. But we are taking advantage of it while we can.
If we were to get into, and you had mentioned MakerBot being one, you talked about another deal, Outbrain getting some money, but Outbrain had bought Visual Revenue not that long before, which I think many perceived as part of a run-up to increasing revenues to be more appealing in an IPO. Within your portfolio, or just anecdotally what you're hearing, are there some terms that are new terms over other years, or are there more any market changes in things like, for example, size or scope of indemnities or management rollovers or things like that? Any observations you have?
I'd say we're seeing big escrows, big earnouts, and a lot of pressure on management teams to reinvest a portion of their holdings. I think smart, large acquirers, people who have really invented the modern tech M&A game, are focused on those things. We're seeing tactically well-played efforts to split the incentives of management and the investors in the process. Finding ways to put more money in the hands of management outside of the normal course of the consideration of the transaction in the way of the long-term agreements that are offered to them, which can basically lead a management team to sort of throw up their hands and say, we're just better off taking this deal than we are continuing to work for their existing investor base. You kind of have to anticipate that, particularly when you know who the acquirer is and their history in the category. Some of that just tactically we've seen over the last few months. But ultimately, I think the real leverage in the conversation rests not on terms, but it rests on the strength of that portfolio company's core business and the ambition and the belief of that board and that management team that they can remain independent and take it further. And I know, I won't speak for the MakerBot guys, but just from RRE's perspective, we love that business. We would love to still be private shareholders in that business because the company was growing so incredibly fast. And we think selling was a logical decision and the right decision. But when you get a good company, we do at RRE, and you get a really great company that's really pioneering a category, that's doing really innovative work, you kind of want to ride your winners.
We look at Voxel Jet, right? So there is a very small 3D printing IPO that got done, flouting the norms, pushing a new category forward. Yeah, might have worked for MakerBot. I know it felt like a loss to the New York tech market.
Well, they haven't gone anywhere. but there is, I think within the New York tech community, I think there is this craving for some independent, long-term standalone companies here that are gonna try and become the next generation of big standalone businesses in the category. And I think some of our CEOs have that kind of ambition, and they have the investor base to help get them there. but it has been just the geographic weight of Silicon Valley versus New York in some of these industries is such that there's going to be a ton of pressure on them to sell.
Yeah. Well, I mean, but I also think I'm like many here who root for and promote the New York market, and that the Tumblr acquisition felt like a good thing. It didn't feel like we were losing anything to anybody. It felt like a great outcome to demonstrate that you could build a $1 billion plus business here. Waze being another.
Shutterstock.
Yeah, Shutterstock being another. And there are lots of ways to do it. So speaking of kind of calling out deals by name, there's one deal that as you mentioned earlier, Twitter had announced their filing, and I think it was pretty big news that it announced that it was going to go public on the NYSE, and it would probably be interesting for the folks here to hear any of the insights on why you were involved in that, David. Anything that you discussed that you think might have informed that decision for Twitter, and also let us add congratulations.
Thanks. As I said earlier, and we'll keep this brief, but I think I said this to you, Tim, was a wake-up call for a smaller and smaller group of people now. I think when LinkedIn chose us, that was probably one sort of concentric circle, and then we narrowed it to a smaller set with Twitter to say the New York Stock Exchange is really active in the tech world. We actually led the IPO market in tech last year with more than 50% of the deals, and we're currently in that same spot today. And Twitter is obviously a very nice win for us. We're excited about that. But if you look back at the record here, it's folks like Tim and his team who bet on us, the trust of people like Nikita and Will sitting where they are because they're informing their management teams and helping them through these decisions that enable us to be where we are. And in 2006 we had 10% share, and last year we had 53. This year we've been running around 60%, and that's when we look back on it, we were quite pleased. Of the top 20 VC-backed deals by market cap last year, we got 16 of the top 20, so it was 80%. And the one we missed, Facebook, may have helped us reasonably well. So in any case, we're excited and humbled by it.
Yeah, well, it's a commendable record.
And so but the things that we're talking to people about are not different than what we would have said to you. And it's simply the trust in us and in our ability to execute, helping us understand your business so we can partner with you either with the B2B network that we have or the B2C messaging we can deliver through the platform, the media platform we have. And then it's for some people about the global footprint and the brand alignment. And so it's pretty simple, and we can make it a compelling discussion when we really understand somebody's business. And when you go back to LinkedIn, that was kind of what happened there,
Yeah.
Where they just kind of met with us as a courtesy and then walked out and said, wow, these guys really get it. And so, we hope to continue that.
So Tim, as someone who's been involved with public companies for a while and been through the process to go from private to public, were there market differences as a finance professional doing it first time around and now, and living as a public company now? What are some of the things, if any, that sort of stand out to you as being easier or more trying or more rewarding?
Yeah, I think the exchange. I think you're referring to the choice of exchange, which I think is that's probably lower on the list of things that are game changers. Present company notwithstanding, I think we were actually a guinea pig on a couple of these things. So it was not obvious when we looked at NASDAQ and NYSE kind of side by side. It was not obvious that we were the kind of company that should do one or the other. And I think where we came out on a lot of decisions that we made that were not kind of clear-cut analytical decisions was, well, who were we, what was our brand, and how did we want to sort of build that brand, and who fits with that brand. And I think one of the things that we're kind of proud of is being part of the New York community. Not that there's anything wrong with the California community, but that we're truly a New York City tech company, and that's not so much around just pure technology and building software code, but it's more about technology and media and people and fashion and a marketplace. Shutterstock's a marketplace where we have people on both sides buying and selling. And that was one of the things when we went to see the folks at the New York Stock Exchange. There's people there that we could sit with and talk to, and they're there every day, giving us information and sort of helping partner with us. And so that was probably the one thing that tipped us over the edge, but it fits with some of the other things we're doing. There's another thing I think might be interesting is on the Jobs Act. We were also a little bit of a guinea pig because it had just happened, and all of a sudden we were faced with this, laundry list of questions and options where we had to make choices. What were we going to take advantage of? What were we going to skip and do the traditional way? And again, there was no sort of obvious path of success that we could follow, so we had to kind of make it up on the fly. We ended up, again, sort of going back to our roots as a company and saying, what's our brand? What do we want to do? And one of the things that helped us to make the decision, and might help some of you, is we knew that we wanted to lead our market sector. We knew that we weren't going to be one of 10 companies sort of fighting it out in a space that was being defined. We're licensing images. The business has been in existence for more than 20 years. And our goal, our ambition, is to lead this business, to be the leader someday. And what we decided to do is we want to be just like every other company. We want to not add another kind of curiosity or difference where we had to say, we're a little different, but here's why that's okay. So we said, we're just going to do it just like companies have been doing for the last 10 or 15 years. Now, 18 months later, a lot of companies have taken advantage of the confidential stuff and more limited reporting, and that's great. If we were faced with it today, we might make some different choices. But my hunch is that we'd probably end up where we did end up, based on the kind of company we are and our softer goals, as opposed to just the more analytical goals.
That's great stuff. And I was not showing for an NYSE versus NASDAQ comparison.
We appreciate it.
But if it handed one, well done. All right, well, we have a few minutes left, and we appreciate everyone's coming to join us and be here for this. So certainly happy to open it up for questions if anybody has any that they'd like. Sure.
My name's Irene Mapp. I was the CFO of one of the first alley companies to go public, and I have a question for, I guess, Brian and maybe some of the VCs. In my day, you went public to raise the money. There was not kind of this so much showing and let's use the IPO as a process for maybe getting acquired. So how has that changed the types of contracts you have as an investment bank? And do you have a clause in there that you'll represent them if there is an M&A transaction? Because that didn't exist in my day.
Well, we'd like to have that.
And will you guys
usually is not on it. It's usually not how we start. First of all, in our philosophy we take as a banker is we're going to start an IPO process. We're not doing it as sort of a ruse or a red herring to get the company bought. It's we're going to work with a company that actually can go public, and all the questions about how big you have to be and all that kind of stuff, and that all waxes and wanes. But one truth is remain constant, which is you've got to have the operational foundation in place to be able to be a public company. And so for us it's I guess maybe old-fashioned is we're going to work with companies we feel confident have that operational and foundation in place, can be a public company, and and are absolutely prepared to go that route, and we're going to be happy having our name as a part of that. If it's a company, if for us it's great if we can add value beyond being an underwriter by also being a strategic advisor, and if we can lock that in contractually, that's great. Usually these things sort of aren't codified in the beginning like that. It's more evolutionary that you're working as their banker to take them public. Somebody comes along, and then all of a sudden there's a big flurry of activity, and we want to be there next to our client and be their advisor. But it's usually it's more of an evolutionary process when we start out and we sign an engagement letter saying whatever outcome, we're going to be your banker.
I agree.
I would just add that I think for us, we're often looking for very different things in the way of that advisory relationship. In the transaction that we recently announced, Whiptail's acquisition by Cisco, We had an extraordinary advisor who's just an M&A advisor. We had also identified a group that we wanted to help us go public if that became an option for the company. Very different profiles in the kind of advisor that they were. It really came down to the skill sets of the individual partners in that case.
Sure. Say you're a late-stage venture company looking to go public. There's increased filings and just all the stuff that a public company does. Is there any sort of rule of thumb as far as costs that you need to allocate to all that sort of stuff, or is it very sector-specific and company-specific? Because you're talking about, you got to build stuff before you undertake that just to be able to run once you hit the public environment.
I'll take that one. So here's what you do. You ask 5 people that have done it to estimate the cost, and then you take the average of those, and then you multiply by 3. And that's how much it will cost. And build that into your budget, and you'll have a little cushion.
Okay.
No joke.
The cost of Starbucks from the Jobs Act, there was a deck that we used when we went down to DC to talk to all the congressmen. And the analysis there said Starbucks was somewhere in the neighborhood of $1 to $2 million on average for a company. So that's just one piece of it. So it can get expensive, and obviously, if you're in multiple jurisdictions, you know, as a company, it crosses borders. This can multiply quickly, so it's expensive.
Not to mention the time it takes to devote to investor relations, not just the cost that hits your income statement, but
The cost is actually the easier part, meaning if you have the funds to pay the cost, it's easier to get your arms around that. It's more the mindset change and the process change that needs to really flow through the whole company, or a good proportion of the company, and that even in the most pro-change company takes some time to work that through.
sure.
I'm Susan Krause, Green Corsair Tech Labs, and we're in the biotech life science sector. So I'm meeting actually with sovereign investment funds and cross-border and U.S. institutional investors. And in terms of debt finance, there are advantages that's much faster in terms of closing that type of financing versus equity financing, or at least that's been some of the advisors that I've spoken with have relayed that to me. But in terms of Credit Suisse and David, what type of terms have you negotiated for your clients in terms of debt finance or convertible debt? These are significant figures, non-figures. So what are the terms attached to that debt finance from an institutional investor or a sovereign investment fund?
Yeah, well, I mean, it's going to depend on the market that you're doing. Okay, so a lot of what we see on, in the past. And Will, you see a lot of these, I'm sure, in your portfolio, right? Probably in the last 24 months, I've probably seen 75 note deals. They aren't from sovereign wealth funds, and they're not for, 9 figures, right? They're somewhere between $500,000 and $2.5 million. Those have totally routinized terms, which essentially, 1 to 2 year maturity, repayable on demand after maturity upon, demand of the majority of the holders. A principal amount. 2, mid-single-digit interest rate, right? 5 or 6% these days. 20% discount, and that's whether you think you're going to do your next financing event in 6 months or 12 months or 24 months. Doesn't matter. People never back down on that. There are great reasons why people should do things at par. If it's a true bridge to get somebody to the next round, that people just don't. It's going to be 20%. Then the only other issue is whether it's going to be capped, and the cap is just basically a snapshot of what people think the next valuation is going to be, plus maybe some nominal upside from that. But I think if you're asking Brian if he's negotiating, a debt deal with a sovereign wealth fund, those terms could be anywhere around the map, and there are going to be huge equity kickers associated with that. And the deal I just described to you, by the way, is it's called a note round, right? People call them bridge notes or whatever. They're used a lot in angel or seed financing, but they're essentially an unpriced equity round, or an indeterminate priced equity round, where the equity price is determined later. And some things like that happen where you have guaranteed return instruments sometimes in leverage deals. But I don't think, if we're talking about something other than that, or if we're talking about big sovereign wealth fund deals for 50, 100 million, I don't think we're necessarily going to be able to say, here are your norms.
The only thing I'd add on that, and this is really just for people in the room who are interested in these kind of convertible note structures, because we see them a lot, we use them a lot in seed deals. I was not a fan of these when they started to come into vogue a couple of years ago, mostly because I think you're really kicking the can down the road about the valuation question. And by doing that and taking a note structure, the investors are actually taking some unstated risk, which is you can set yourself up for a renegotiation of that convertible note in the terms that you've agreed to there. And there's some amount of retrading that often goes on when that convertible equity round actually finally comes together and the valuation stuff does come along. And we haven't given up anything that I think was very meaningful there, but it is a little bit of a deferral of the valuation conversation. We're equity investors at the end of the day. I frankly don't want to think about the interest calculations on our notes, nor do my limited partners care in terms of what it does to the return on our funds. We don't generally expect to collect it. In fact, we hold almost all of our note securities in our financials at cost.
Excellent. All right, well, thanks everybody for being here. For those of you that it might be of interest to, we have a panel tomorrow evening here on big data and fashion. Thanks again.